Nervous?
No, I'm good.
You're like a duck on a pond. On the surface, everything looks calm, but beneath the water, those little feet are just turning a mile a minute. You'll be fine. You just have to find a way to lead your team, earn their respect.
Yeah. How are you doing?
Me? I'm just another duck on the pond.
Hey, Coach, can I ask you a question?
Yeah, shoot.
Why me?
I look at you and I see two men. The man you are, the man you ought to be. Someday those two will meet. Should make for a hell of a football player. Get some sleep, kiddo. You're playing professional football tomorrow.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 28th, 2025. S&P 500 currently sitting at 58.56. I'm David Zarling. I'm here with Ian McMillan. I feel bad that a few episodes ago, it was just Gene Hackman's birthday. I thought he had passed away at that time. And now
it's tough.
And now he has passed away.
Yeah, we lost a good one.
Yep. Lots of good movies with that guy. What's your favorite one?
Hoosiers.
Yeah, it's got to be, right?
Coach Norman Dale.
Norman Dale.
Golly, that was good. I mean, that's like I feel like probably at least most boys, their dad watched that with them at least once or twice.
Yeah, it's a good.
Maybe I need to do that with my boys this weekend.
Yeah, great movie. You know, I think an underrated one is Replacements.
Yeah.
He's Jimmy McGinty, man.
And they had, what's his face was the quarterback in that? Keanu Reeves?
Keanu Reeves. Yep. Falco kind of had to find himself. Makes sense. Just really good actor.
And then things that were like before my time now, like French Connection. I don't think I ever saw French Connection.
No, I never saw that either. But did see, Behind Enemy Lines, or like, I think he was he Hunt for Red October? No, Crimson Tide. Crimson Tide, great movie. Denzel Washington, Gene Hackman. Probably should watch that again. I mean, that's 1990. That's 1995. You were like 3.
I was 8.
Okay.
Thank you very much.
You probably couldn't stand it because the pixels on that will be so grainy. It's not black and white. But anyway,
I'm not that much younger than you.
I know.
All right. So what happened
this week? What happened this week?
Yeah, well, last week the episode was titled Bearish Thesis.
A little bit of follow through from last week.
Yeah, so that's last week we kind of laid out, literally the bearish thesis, decent rollover. So far, seems to be playing out. Not great on a lot of indices. I mean, Russell, we can talk about the Russell, and it is well below 200. I think it was actually below a 200 last Friday. Might have closed below 200.
Yeah, small caps still remain weak, and still, last Friday closed below a 200-day, and now here we're sitting on a relative basis versus the S&P at the levels we saw back in July of last year. Some small caps remain a weak spot. If you were to think about year to date, and I told you technology was down 4.8% and staples were up 4.8%.
Wow.
I mean, that's something that maybe should have you sit up and take notice.
It's information. Now, it's definitely something that I take notice with. That's pretty clear, right? You've come into a brand new year. We've all had, at this point, 8 weeks to buy stocks. People are buying more consumer staples than tech now. So the part of me says, okay, maybe an orange flag, but I guess at least they're buying staples instead
Right.
of everything just going down at staples just going down at a lower rate.
Yeah, that's right. That's when you get a little bit, that's when you should be much more nervous or appropriately risk averse, is when staples are going down and just going down less than the other things. Because you still have things like financials
Yeah.
and
Financial.
energy and
Yeah.
real estate. Some would argue those are value areas.
You mentioned the zero line last week.
Yes.
Where are we at with that?
So if we use the S&P, and that's a term I've come up with, I don't know if it makes
like
sense.
it.
But I
I
like
think
the
it's a
term.
good term because it's a mental, whether people realize it or not, it's kind of like an invisible line in the sand.
It is. Like how many times
Mentally.
how many times when you look at statements, or whether it's for an ETF, a mutual fund, or even a client statement, how much bias anchoring happens on January 1st and December 31st. And so now we're talking about an environment where S&P is below the zero line being 1231 closing price. And on S&P cash, that closing price was 58.68. We're actually below that currently. Obviously, small caps more so. NASDAQ is as well. What's interesting is, you could also point to international using something like VEU is positive year to date. But it is interesting because, invariably people look at, well, what was my performance last year? What was my January 1st to December 31st? Even though the market doesn't necessarily care about that, people do.
People do.
And it's a behavioral mile
Mentally,
marker.
yeah. I think it's a big mental conundrum for your average investor.
Absolutely. Because let's be honest, most investors, most advisors don't use charts. They just use tables, or they use, percentage numbers on a sheet.
And I think that,
Without
right? And I think that leads back to a lot of behavior towards your high water mark.
Mm-hmm.
Well, I was at X in December, and now look where I'm at. I'm already negative, and it's only February. Whereas, like, it's just, if there was no calendar, you wouldn't know the difference. It would just be another regular midsummer correction.
Something like,
because this statement that has these dates labeled, and when you only look at it, right, I would say most people, if you've got an advisor, how often do you think that their statement is their kind of one time a month that they look at, like, quote unquote, how the market's doing or how they're doing?
I think that's fair. Like your best behavioral control for investors is not to be looking at it on a day-to-day basis. At maximum once a month. The really good investors, clients, are the ones who look once a year. And typically that's a 1 to 1231. Yeah, that's because they're able to understand that markets don't move in a straight line. And so the things that happen between two dates, and we can really pick any two dates.
You can.
Just, the world just loves one.
Isn't it? But we are so obsessed with December 31st and January 1st, or month to date, year to date. And I get it's kind of like the SAT. You got to have some type of qualitative, you got to like snap a chalk like somewhere so we can compare what people did.
Yeah, but it's nice. And it's nice.
As far as like your retirement plan, it's pretty insignificant.
Right. Because even though international has outperformed year to date, something like VU is still 0% return since 2007. So it's about context. It's about, okay, let's look at this snapshot, but then you got to look at it within the bigger picture of where are we? And even something like VEU versus S&P, I mean, yes, positive year to date, but since 2007, down 75%. Yeah. Like so it's still in a downtrend, and you have this reversion of something like VEU versus S&P to a 200-day. There's a lot of mixed information currently. And what I mean by that is, okay, we could look at year to date. We could say, wow, Staples up 4, tech down 4. Then you also have to be honest and be like, but there's also demand for international year to date, and there's demand for financials. That's typically not what you see in a broad bear market.
No.
And last week we highlighted, the zero line, where we closed last year, the 200-day, the election gap, also important, right? That's another.
Yes. Election gap is a big mental. I think from a technical standpoint, it's a big move across 90% of charts out there.
Yeah. So where are we at in that? Where we are compared to November 6th, if I have the date correct.
So yeah, the 5th. So we're going to talk about the Tuesday close, right? That Tuesday, you get the election results, and then you have the Wednesday gap. Just so we're clear on how this works. Obviously, futures aren't going to have as much of a gap, so we're going to use cash. S&P. Now, we're going to put an asterisk. It has filled this gap once. We have filled the election gap once in mid-January, so we have revisited this before. We are back in that gap. As of yesterday's close, we are back in that gap right now, slightly. We're going to call it flat in the S&P as we're recording. We're down 1 basis point. So we're still technically in that gap. IWM Russell has been through that gap for a while. It did also fill it back. Actually went below it in mid-January, and we are below those January lows. So Russell 2000 small caps, we are definitely negative from the election results. Mm-hmm. How much do you put into that, considering it's been a laggard for so long? I don't know. It's a tough. I mean, you would want to see it. It was definitely an outperformer, right, for a bit, a little bit after election. NASDAQ never filled its election gap, even in mid-January. We're basically back to those same mid-January lows. So nothing on the NASDAQ yet. We got back into the gap, but never filled it. Dow filled its gap mid-January, reversed pretty nicely, and right now it's not really even that. I mean, it's the Dow. It's held up the best, right? Growth has gotten crushed. Mag 7's definitely taken a hit. So the Dow, during this whole correction, the Dow's, held up the best, quote unquote.
It's an interesting, the zero line, the election gap, interesting behavioral market markers.
Yes.
And we can use that as information too. So for example, it's not even close to having filled its election gap? Financials.
Yeah.
Communication services. So we can use this information to be like, okay, what is the market environment? Where is the strength, right? Because we've had weakness. We should really be paying attention to those things that kind of have bypassed any weakness. And so when you see financials strong since then, or you see communication services strong since then, and not even close to approaching those gaps, that's information.
So you like financials, so we're buying regionals?
You mean that? Are you saying like if you're going to be financials, are you talking about versus regional banks like that way?
Yeah.
Well,
isn't it fascinating? Because you would think so, right? But the answer is like, no, I don't think I would be in regional banks. But you do want to own financials. I mean, they're even today. So yesterday, year-to-date relative highs, continuing that today, really grinding back through this whole March 2023 banking crisis thing.
No, you're absolutely right. And you could even make an argument for European banks, right?
Woo! Lloyd's? You're telling me I'm buying Lloyd's? What are we buying in Europe? Barclays? I can't believe. Yeah, look at these. EUFN?
Yeah, there's
financials.
Yeah, and that's just not something that has been in favor for such a long time.
Why do you think that there's been this shift to, right? Because I don't pay attention to the fundamental aspects. I wouldn't say that in the last 3 months there's been some massive change in European economic policies. Why do you think we're gravitating towards European financials?
I mean, that's a great question. It could be simply typically when trends change. So let's say you have an uptrend and that shifts to a sideways trend or downtrend. It's because you've run out of buyers. It's not because it's selling is picked up. In this case, it would be vice versa. These things had been beaten to the ground so bad, you kind of ran out of sellers. And let's be fair, European financials using EUFN, we're at the highest levels since 2014. And really, you could make an argument going back even further. So we're talking about a 10-year return on European financials of 2%. So is it rotation? Is there interest rate considerations there? Are there better margins on loan creation?
We'll never know, Dave, will we?
No.
What the reasons are.
Yeah, we'll just stick to price because typically what you see by the time, here's where you get nervous. If all of a sudden there's magazine covers or headlines all over the place about the new bull market in European financials or Europe,
We should be buying Banco Santander.
that's when you get nervous. Is, oh wait,
That's
prices
true.
are-
I mean, and that's I think that's such a great point because, and I mean, I'll be the first one to raise their hands about people who have pooped on European equities for many years. And if these things, and we all know behind all that teasing and trolling, right? We all know that there will be a time when financials outperform U.S. financials or just ex-U.S. stocks in general outperform U.S. stocks. But it's going to take a long time, I think, before people jump onto that.
Well, that's the beauty of where this stuff is at right now. Is it's not like anybody's missed the boat.
No. I think that's a great way to surmise it. Yeah.
And it makes, when you look at, I'll bring up two relationships, Ian. When I look at European financials versus semiconductors, EUFN versus SMH, and I see that that's breaking a rate of trend that goes back well over 10 years, well over a decade. But I compare European financials to US financials, and it hasn't broken that same rate of trend. That's a clue. Oh, wow. Like there's strength in financials overall and still in US financials. And how big of a bear market can you get if financials are doing well? And so, yes, we've had this corrective behavior. We outlined all the things last week, whether it was VIX dispersion or really high levels of volatility shorting, or maybe I should have you talk about surveys like the AAII.
Yeah.
Oh, bears, you want to talk about some of that?
I want to add one thing on the financials, and then for the kind of global outperformance that we've seen, I would just say that I think it could be more evidence that where we are at for interest rates is going to be kind of the new normal, right? That's always been kind of the dig, is that the interest rates weren't there for banks. And we know that's the big gorilla in the room. The 800-pound gorilla in the room for banks is lending and making a spread on lending. Much easier to do that at 7% than 3 to 4%. I kind of think, and I'm not trying to get on some macro fundamental soapbox, but maybe, just maybe, that's the equity market telling you that, yeah, I think these banks are going to have a while with higher interest rates and they're going to be able to make some pretty decent spreads.
I think it's an absolutely fair way to look at it. Markets are, and this is what people forget, markets are a future discounting mechanism, right? They're looking out 6 to 18 months in the future on the prospects of that company in relationship to the economy. So another example, that would be NVIDIA earnings.
Yeah. There was supposed to be a big move over that.
Right. And they blew it out of the water. They had great earnings and you had a bullish engulfing on that. Does that mean the
200 day?
Below a 200 day? Does that mean things are done for semiconductors and NVIDIA? No. but it is good information about those earnings, and their exceeding earnings estimates was something the market, it looks like at this point, was already priced in. It's not looking backwards, it's looking forwards. Like, what is the likelihood that that continues? And so you're right, you do have this dichotomy between semiconductors and financials. Do you have a scenario where financials actually outperform semiconductors? And when you look at a chart of XLF versus SMH,
I have to put my money on financials.
right?
That JPM relative chart.
JP Morgan.
Yeah, the relative chart. I mean, it's breaking back. I mean, I feel like that gets brought up a lot in our workbook conversations.
And so you do have an environment. I get it, right? When you look at, let's just look at the makeup of the S&P. Get it that technology stocks are at 30% weighting and financials are minuscule, right? Meaning they're like they're half of that.
And didn't we always know it's going to be a pain to get out of this?
Right. Because you have such big names that are so large.
Yeah. I mean, how do you get out? How does an industry transition out of a sector that's 30% of the most important index without it doing damage?
Right. It makes it really hard if you're Magnificent Seven, if you're seven largest are struggling, but that doesn't mean there is an opportunity. And so it's interesting, and I'm sure there's some listeners that are like, hey, you guys brought up this bearish thesis last week. The market did decline since that episode. Aren't you more bearish this week? Well, maybe. But some of these other lines in the sand have to be broken. We're still above a rising 200-day on something like S&P. Yes, we're below a 200-day on small caps, but there's so many areas that are still in technical uptrends. And we know that we get 3.5 to 5% drawdowns per year. We know that we typically get 10% drawdown per year. And I understand.
How far are we off the highs, Dave?
I believe we're only like
4.5,
4.5. Let's take a look. 4.5, like 4.25 off the highs. And here we have bearish sentiment through the roof.
Yeah. So we have that on our list to talk about. And I think we discussed it last week.
And it's even more bearish this week. We discussed it last week, but it's even more extreme now.
But I want to go. I want to make sure I have these stats right. And we're talking specifically about AAII.
Right.
I've still, as an active investor, I've still never been asked to participate in this survey.
We're active investors. We manage money.
Yeah.
But I've never gotten a phone call.
Yeah.
I've never gotten an email.
Pretty considerable amount of money, but no one's ever asked me my position. Anyways, I digress. So, according to Dietrich,
Ryan Dietrich, great.
Ryan Dietrich, very common name. I mean, we probably quote Ryan.
Yeah, at least every week,
twice a month. Yeah, I mean, probably at least once an episode. So we've got the largest spread. So these are people reporting to a survey, whether they're bullish or bearish. And this is the largest spread since the September 2022 lows. Is that correct?
Yeah, the largest spread since the 2022 bottom of the bear market.
And
I mean, that's pretty incredible. We're 4% off the highs.
And it is, to your point, Dave. And there's a little bit of data mining that was going on. So Ryan Dietrich has 55%. If you do 55%, you do get the 08 top, right? People started getting bearish in 08. For the most part, these readings marked a bottom. If you move that to 60% spread, which we did also hit this week, it's basically all bottoms. I think it was Sentiment Trader that maybe had that. It moved it to 60% spread. Don't quote me on that. But either way, I think I tell you how it's just fascinating is my friends have texted me. I have friends that follow Ryan Dietrich that are not involved in finance, but they love Ryan Dietrich. And they text me about they'll text me in like his tweets. And this has been a decent topic of conversation this week.
Okay.
Because it's kind of right. You're telling me, and so we also have to think this survey was taken when last week. So
Yep.
did we actually have the sell-off, or was this taken on like Tuesday, and then the results came out Wednesday? I don't know.
Yeah, I think it's during this week.
Okay, so we are, let's say, 2 to 4% from all-time highs. A very, very, very basic event that happens multiple times a year, even in a strong bull market. And it's the same amount of, if we can use the word fear or skepticism or whatever you want to call it, that we had at the 2022 bottom, that we had at 08, then we had at the 03 bottom, that we had at the 1992 bottom, or 91 bottom. That is absolutely fascinating to me.
And it, like we covered last week, there's this juxtaposition between that survey, so what people say,
Yes,
versus what they're doing.
that's a good point.
Record level lows in holding cash last week, based on Bank of America Global Fund Manager Survey. They're holding like 3.5% cash. And to your point, going back to 0809, they were holding close to 6% cash. Now, those two numbers seem very minuscule to me, because when we take our foot off the gas,
our left lane driving is a little different.
Yeah, we definitely get very aggressive, but then also in periods like this where we take our foot off the gas, one of our models, for example, more like 20% cash. But anyway, point being, you don't have fund managers, as of the data the past 2 weeks, doing what they're feeling. And so it's going to be interesting to watch. Do they actually act on their feelings at this point based on what happened in the market this week? That'll be interesting to see if now, we did see hedge funds, we talked about this 2 weeks ago, deleverage pretty aggressively, but we do have fund managers who are sitting with record little amount of cash. Do they start to raise that cash? Do we start to see put call ratios rise, which they have?
Oh,
last
okay.
week,
So that was going to be my next question: is what's going on with PC ratios?
Yeah, put call ratio has risen. Nothing crazy,
but no like spike like we had probably back in August. I don't have the put call chart in front.
Oh yeah, so like if you look back to like you're talking about July, August last year, where we did have a bull market correction. You were sitting, I don't know, north of 0.8 in that, and when you were in the depths of the bear market, you were above 1 in that relationship, and in some cases above 1.3. So really aggressive hedging, which typically happens during bottoms, and then puts become future buyers, right? Because when you got a cover, you actually have to buy the thing that you were shorting. We haven't seen necessarily put call blowout to the upside. And it's really interesting because you've got the sentiment, you've got the positioning. You don't have hedging against that positioning crazy at this point.
Yeah.
Yet you have the VIX at 20. So is there one more flush?
That's what VIX at 20, which is nothing compared to, we've been here multiple times from the October 2023 bottom. We had the yin whatever thing, August 5th.
When VIX shot up to like 60.
Yeah, and that was I remember thinking Cinnamon Trader said, if you have a 50% move in the VIX or something over like 1 day or 2 days, that the next month or 2 months is always positive, which that panned out again. Go figure. Yeah,
Well, and last week we highlighted how we have the same amount of positioning short volatility. So making a pretty large bets on volatility actually falling, which we've had the opposite so far since July of last year. And so you do the how would I put this? The environment is set for some type of sharp move to the downside if it wants it, if the market wants it.
If it wants it.
And what's interesting is that would then most likely, doesn't have to, set up the sequence for the next 6 to 18 months higher.
Yeah.
Is you've had a lot of cash raising, a lot of hedging, buying puts, raising cash at just the exact time you shouldn't be doing that.
And one thing we've talked about is a lot on our team. We still haven't had an 80% day either one way or the other.
Right. We haven't had, yeah, you're right. We haven't had an 80% upside day or an 80% downside day. So that's another great point. That's another piece of information where
There's
we
no
get an
real
80
flush any like yet.
Right. We haven't had a flush. So is that still there? Do we still have the chance for an 80 or 90% downside day in the next 2 weeks? I think that possibility is there.
Percent back in O's at
Yep.
sitting at 40 so this is as of yesterday's close, sitting at a 42. Well, 40, we'll call it 42, 43. Anyways, it's on the negative side of the 50-yard line. We are in our own territory and need to get back into the defense's territory.
Right.
Yes. So you've kind of got to pause right there. It's not terrible, right? I mean, in 2022, you've got O's down in the 20s. We're sitting at 43 right now, 42, 43. So it's not terrible, but it's definitely just kind of a meandering reading.
Right. And we haven't tested the 200-day moving average on the S&P since October, November of 2023.
No, we haven't. And so to your point, X's and O's then, bullish percent, the 2023 lows was a 30.
Yeah.
We're sitting at 43. So there's flushy-ish room. VIX, I don't know. Now there's always, right? There's always a theory that, VIX and S&P don't necessarily have to move directly.
I think, the term flush, what I want to paint for our listeners is you can have downside price pressure, and typically you see that end with a flush, meaning like this really sharp move. It gets everybody on the wrong side of the boat, and then the boat tips the other way.
Like a December 2020 or
Right.
2018.
Right.
Boy, I'd say that was the first. That was definitely probably my career. It was the first. Oh crap!
Yep. And so the oh crap moment could still be upon us. Like, it doesn't have to. We could hold the zero
bottom, right?
We could hold the zero line. This could be it. We could hold these lows from January and something like the S&P 500. And if we do, what's great about this is if you're a student of markets and you study supply and demand and how this all operates together, is we've seen recent market weakness. We have the S&P on the verge of being negative year to date. Where do you need to be looking? You need to be looking at what has strength. Okay, what things are strong? And we previously identified that with things like communication services, international, financials. When that beach ball gets released from underneath the water, how much stronger will those areas be? That'll be something to pay attention to.
And the data says likely that those will, if you went out 6-12 months, those will end up also being your winners.
Right. And so we're getting good information from the market. When market has weakness, when you're in a sea of red, you want to look where the green is. Now, the question now becomes, does the sea of red get darker red? Do we have that flush, that move that really gets people on the edge of their seats, that takes us beyond a 200-day, that takes us to the election gap? That's to be determined. I wish I could tell you. I knew that was going to happen. I don't. But you could see a scenario where you get a flush like that, you get a VIX up into the 30s or north, you've cleared out all the volatility shorts, you've got a rising put call ratio, and all that whole scenario is fuel for the next leg higher.
And I think that's when your absolute charts come more into play. Like, it's financials. Yeah. Let's do. Great relative charts. They are actually filling. We are really back into the thick of it. And I mentioned this early for March 2023. I know that was almost 2 years ago. The banking crisis really did massive damage to the relative chart for even an XLF, which is all financials.
Right. Well, that was a Six Sigma event. That's something that's quote unquote not supposed to happen in a million years.
It's really, I agree.
But it's markets. I mean, things happen all the time that aren't supposed to happen in a million years.
I think with like an XLF, I mean the absolute, like an XLF absolute chart is not falling apart yet. That's where you still, I think, gotta have some. It can look great on a relative basis, but if, again, kind of like we talked about staples earlier, if it's just underperforming to the downside, then it's still not. We don't want to be involved in that.
Right.
And that's actually the first thing we start off all of our prospecting client educations with, is very first pillar of the 3 pillars is absolute trends. Like, you gotta be going up first and foremost. If you're even going to be considered buying, then we'll filter it down whether are you better than some other stuff.
Right.
But yeah, XLF, your JPMs, your Bank of Morgans, your Berkshires. I think Berkshire I mean, Berkshire looks great. They had earnings. I thought it was this week, right? Yeah, Monday. Got to all-time highs. Relative chart also getting to, I can't remember who had financials work, but like the Berkshire chart, I mean, these are your important stocks, your big banks in Berkshire, and they look, that's great. I mean, it's a good looking chart.
And then we have crypto.
What happened with Bitcoin this week?
Well, it broke down out of the consolidation that had been going on, since November of last year. Had built a nice consolidation between 92,000 and 106, we'll call it, using round numbers. Broke down out of that, touched 78.
I didn't realize that. We went down to 78,000. I guess that was overnight last night.
Yeah, so pretty big move, reclaiming the 200-day here, and maybe that's the flush.
Yeah,
maybe that's the flush. That's from a risk appetite standpoint that you're seeing Bitcoin. Basically, that's a pretty big move, and then reclaiming a 200-day
from 109 to 78.
And there's a pretty big, volume profile pocket here between, 70,000 and we'll call it 86,000. So will Bitcoin fill that in and find out where the real buyers are? That's the beauty of price discovery.
Also went down to the relative 200-day versus the S&P.
Okay.
Visited, the relative chart of Bitcoin versus S&P, pretty fascinating with the last 24 hours. From a risk reward standpoint, I do not hate it. I do not hate Bitcoin at 85,000.
Yeah, there's a lot worse places you could enter using a relative chart.
You get back up, and you get it back up above 91, 92, 93. I know those sound like big numbers, but from a percentage standpoint, they're, in Bitcoin terms, a few $1,000s. It's not necessarily a huge spread. Yeah, we'll see.
We will see.
It's 150 Central on a Friday, so who knows where we close. But as far as, Bitcoin peaked early, it peaked, it made its high back late January.
Right.
Before stocks. So are we going to see it also find a flush and demand early? I think that's a practical argument. Bitcoin's got to be one of the biggest. It's when you're looking for like risk on cues in the market, Bitcoin's got to be up there, right?
And I think it's also, you're talking about a $1.6 trillion asset. And that's just looking at the raw coin. That's not even looking at what's in the ETFs.
Right. That's a mega cap stock.
Right. That's a high beta risk appetite instrument. Maybe we just had the flush in that. Maybe stocks are next. Maybe it's not. Maybe the flush in crypto is some type of bottoming process. We'll see. Time will tell. But it is important to note that it's reclaiming its absolute 200-day. It's relative 200-day after a pretty big move overnight. We'll see what the weekend brings, right? Bitcoin trades on the weekend.
MSTR, which is kind of like Bitcoin proxy plus beta, right? So I've heard it described as essentially a 2x Bitcoin.
Right.
So then if you use a 2x MSTR, you get 4x Bitcoin. Our clients are familiar with that. But yeah, and that's come into a 200-day.
Right. So some really good information. We're right at the precipice. You could see one more flush lower. Doesn't have to happen. Again, we could hold the 1231 line, zero line. We could hold the January lows in something like S&P. We don't even have to fill the gap. That's definitely a possibility. But you could also see an environment over the next 2 weeks where we do see a spike in the VIX, pop in put call ratio, clearing out the vol shorts, and then we're off to the races.
Yeah.
And the scenario I haven't even brought up, we've talked about, do we move higher from here? Do we correct and then move higher? There always is the scenario that we correct and then that's just the starting signal for a new downtrend.
Yeah. I think you could have a decent rally in here and not fix a lot of horizontal polarity levels.
Mm-hmm.
You could get back up to 6,000. You still haven't broken this. So we've got a rate of trend from the 03 bottom, which we hit in that August 05 lows, hit on those January 13 lows. We've now broken this. I mean, we can rally. We can definitely retest some things from the underside and that could take 2 or 3 weeks. And we haven't done anything. I think Andrew Thrasher, I looked for this early this morning. Actually, take that back. I think it was Assad to News. And he had talked about how he thinks best case scenario, we go sideways for a bit. And I do wonder if we are getting up into some 2015, 2016-ish type, right? And you remember that, like, before we hit the top in 2015, we really, like, grinded. Like, if you pull up a chart of the S&P summer 2015, like, it was just choppy, nasty, grind along. And, like, yeah, the index did okay, but... And then we get 2 years. I mean, it's a possibility.
I think it's okay if the market's up 43% since November of 2020.
It's okay to
and
take
now...
a breather.
Yeah, take a breather. And we have moved sideways.
We have. You're right. That's a good point.
We have moved sideways since October of last year. Yeah.
Yeah.
So it's okay that we're digesting. That's definitely a scenario where you digest the gains that have just happened before moving higher. Things you'd be looking for is, as you alluded to before, staples outperforming and they're in a downtrend, which they're not. Or things like, I do think junk bonds versus IEF, intermediate bonds, treasury bonds is worth paying attention to, but they're also at a inflection point at this level. They're at their election day level that they hold here. You've got triple C credit spreads rising, but not what I would describe as blowing out. So you would typically see those blow out if there's a bigger correction coming. You'd see money tightening, those type of things. We haven't seen that yet. We're open to it. We're open to if we clear those levels that we talked about a week ago, using something like a 200-day moving average. Even the supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, uses some methods to reduce risk. That particular product helps investors access two of the most prevalent factors in markets using momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. And even something like that has a way to reduce risk when the market environment changes enough that we're in a new bear market. We're not there yet. We still have stock prices using the S&P 500, using the NASDAQ above a rising 200-day. Now, we have small caps on the other hand, and that'll be interesting to watch on a relative basis because that's, at its prior lows, most recent lows from just a little while ago. So we'll see how that all bears out.
And the Russell 200-day is still rising too. So
and there's volume weighted average price levels here coming up.
there are. So I was meant to bring that up earlier, Dave, especially with talk around January 1st, and we talked about the election. I think those are really good areas. Obviously, I mean, we use a lot of volume weighted average price certainly at lows, big, intermediate and long-term lows. But there are other pinpoints, and I just love your January 1st thing. I think that is such a big mental thing that probably a lot of humans don't even realize that they battle with.
I'm guessing that if you ask,
and it's fair, like I'm not faulting anyone for that.
Right.
It's totally normal.
Yeah, most people, if you ask them, hey, the market's negative year to date, are you bearish or bullish? Well, if it's down for the year, I guess I'm bearish. But this is all happening within the context of an uptrend. If we break below the zero line, well, we'll know that zero line will be reclaimed and will move higher if this is truly the continuation of bull market. It won't. We'll stay below the 1231 price if it's a bear market. It's pretty simple.
Agree.
So with that, we're towards the end of our time. We don't want to create too much work for Kevin. Anything else you want to touch base on before we wrap it up?
So this is not some, oh my gosh, I haven't reacted yet. We are 5 days into a potential larger correction. From a technical standpoint, and right, there's lots of people that say, oh, they sold into strength, or we were X percentage away from some moving at like kind of this, we were too far away from this string. I would say those are not real trend followers. I know some people, CMTs, and I'm friends with them, and they'll tell you when you're drinking a beer with them that they're trend followers. And then they'll say that, oh, I sold this in the strength. I would say like even a Jerry Parker would disagree with that. If you are a trend follower, that you are not selling into strength, like you are simply following whatever your predetermined limits are as far as trend. And, for us, you brought it up 200-day. We're still above a rising 200-day. As painful as the week was, yeah, it could get worse, and the 200-day can flatten out. Right now, we're just a week in.
Right.
So very, very, very little damage done in what was the context of the last 15, 16 months.
And underneath the surface, you've had breath is standing on the floor. Breath is not standing on a ladder with 1 foot in the air. This is not a scenario where you had, breath extended to the upside. You're actually at baseline negative breath. Yes, you could get a flush, but the likelihood of that flush actually being a significant bottoming process, meaning like for a sustainable future bull market, is pretty strong. And you don't even have to get that. You could just have onward chop through March. Markets are going to have a negative February. Perfectly normal. We had so many positive months leading up to this. Perfectly normal to digest price and make sure that the buyers are for real. That's a quality reset for an ongoing bull market. So Ian, I appreciate you being on here. Love everybody that's listening. We hope you share this podcast with your friends. That's a huge compliment to us, and give us a high ranking on your favorite platform of choice. Otherwise, we'll see you next week.
Have a great weekend, everyone.